Good morning. We have Duane Lund with us, tax expert, NAI legacy. Duane, like me, started his career off as a CPA, learned about taxes and how that works with real estate together. So we're kind of two peas in a pod in that our careers have moved on, but we still have tax strategies at the core of everything that we do. So, morning, Duane. How are you?
I am great, and hello everybody. Happy to be a part of this panel. Sorry I can't join you live, but yeah, glad to be here and share some thoughts on net operating losses and taxes in real estate.
So, Duane, if I remember correctly, you sort of got into the real estate business in an UPREIT platform, right? Is that how you started everything?
Yeah, in its simplest form, CPA, much like you at Pete Marwick way back in the 80s, and it just turned out that I was involved in the real estate sector at Pete Marwick, and the Tax Reform Act of 86, changed the game for real estate professionals. And after my run with Pete Marwick, I did move into the commercial real estate space, and yeah, was introduced to UPREITs in early 1990 and the whole tax advantages of an UPREIT transaction.
So since then, if I also remember correctly, you've done a lot of things with the 1031 sector. So whatever you're selling in a 1031, there are things you can replace it with that we're going to talk about in this event, but there's lots of different alternatives, right? And so you're also working with other things, other tax strategies, tax planning ideas. So tell us a little bit about what 2020 brings in terms of tax strategies. And we're talking to high net worth families, people with a portfolio of held real estate they've had for a long time.
Yeah, and again, Todd, just kind of picking up on my career, matching your career, whether it's right or wrong, I was introduced to real estate as a tax tool, almost more than an investment tool. And most people will tell you that real estate is one of the last tax advantaged assets that one could own. And a lot of those tax attributes have to do with what one can do to generate either a tax deferral or a tax loss. And going all the way back to 86 and what we did in the 90s with our UPREITs, which was a 721 swap. And now even today, first and foremost has to be a good real estate investment, but then you analyze the tax attributes and it is pretty compelling what one can do. And so jump forward to now 2020. Yeah, we could sit here and talk for an hour about 721s and 1031s, but net operating losses and bonus depreciation and how one can use a real estate asset to generate a taxable loss, but not an economic loss. And of course, most of that is tied to depreciation, as you know. So in December of 2017, the Tax Act went through, and bonus depreciation was added to the Tax Act, the ability to write off 100% of your personal property in year one. But what was taken away from us was the ability to take a net operating loss and carry it back, Todd. And in the CARES Act that was passed not too long ago, just about 8 weeks ago, there was a provision that allows a one-time event, and that is creating a net operating loss in 2020 and carrying it back for 5 years to recapture taxes that you paid. So yeah, when I look at the tools available to us this calendar year, that's probably the most compelling tool. Is putting capital in play in real estate, creating a loss using bonus depreciation, and having that loss trigger a net operating loss, which we can carry back to 19, 18, 2017, and it's a one-timer.
So let me recap if I can, Duane. So you said this was part of, and I don't mean to get political, part of Trump's tax bill gave us more depreciation, more paper losses, but didn't let us recapture old taxes, right? So
Correct.
you could have paid taxes in before, and those are of disregard. Now we're moving forward. When the CARES Act hit, they now allow you to carry that back and get cash that you've paid into the IRS back by creating paper losses, not economic losses. I like how you say that. So what do people have to do now to make this happen?
Well, we talked about it in one other seminar, but in its simplest form, you kind of have three buckets, Todd. There are those, much like myself, that have existing NOLs that were on our books being our tax returns coming into this calendar year. So those NOLs are there and we can take advantage of them and carry them back. That's the bucket that we all have already in play. The second bucket is taking a look at the tax transactions you've completed the last couple of years, and you can kind of reshuffle the deck, if you will. So you can take a look at whether you write off the amount of depreciation in 2019 and create some NOLs. But it's the third bucket that I think is the most exciting. and that's actually creating new NOLs. And that does require a taxable event. It requires either put a property in play or buy a property, put a property in play by developing it, but acquire a property today in its simplest form, take that asset, delineate between real property, personal property, and land, and that bucket called personal property, you can write off 100%. And that's the
amazing.
play. That's really the play of the day is to put some capital in play and write off your personal property in 2020. As I shared with you earlier, it really is a one-timer because the NOL provisions in the CARES Act expire on December 31st. So I do think, we've had a nice run with the stock market just the past couple of days. I think the fourth quarter of 2020, it'll be one of those periods of time when we can create something that's pretty unique, and it really is a one-timer. Again, whether it's right or wrong, Todd, I've said it before that a lot of us in the real estate industry, we do our tax planning at the last minute, just the way we are, because most of us file our tax return on October 15th. We get our K-1s on September 15th. And it's usually then when we say, boy, what can I do to save taxes? We always do it at the last minute. So I'm looking forward to this fall, the fourth quarter in particular. I think it's going to be a great quarter for real estate investing from a tax attribute standpoint. Should be a good time.
Excellent. Well, thanks, Duane. Duane's company, NAI Legacy, not a tax advisor, but Duane's been in this business managing individual wealth and real estate wealth, family wealth for a long time. So that's great advice.